The Fed did not cut rates. The Fed did not surrender. The Fed still talked tough about inflation, and gold still heard something very different. That is why this moment matters more than most people think. If I'm the kind of calm voice you want beside you when the money system starts whispering before it screams, hit subscribe now, because what I'm about to lay out is exactly the part the headlines keep missing. When I watched this move, I did not see a simple gold rally. I saw a crack in the story the Fed has been trying to tell. Most people still think gold only moves for one reason. They think the Fed cuts rates, the dollar weakens, and gold goes up. Clean story, easy story. But markets are not moved by easy stories for very long. They move when one layer of the story says one thing and the deeper layer says something else entirely. What the Fed did was subtle, but it was not small. It held the federal funds rate at 4.25% to 4.5%. That is the main policy rate. See, it is the price of short-term money in the system. On the surface, that sounds firm. Then, almost in the same breath, it slowed the pace of balance sheet runoff. In plain English, it sharply reduced how fast it was draining liquidity from the system. The cap on Treasury runoff dropped from $25 billion a month to just $5 billion. That is not a rounding error. That is the central bank easing its foot off the brake while still telling everyone the road is under control. I have watched this pattern before. The Fed almost never wants to look soft before it has to. It wants the language of discipline and the flexibility of retreat. That is why this move hit me the way it did. Quantitative tightening, or QT, is just the Fed letting bonds mature without fully replacing them. When that happens, cash is slowly pulled out of the financial system. Slowing QT means less cash leaves. It is not the same as printing money, but it is a clear step away from pressure and towards support. And the reason matters even more than the move itself. This was not done because inflation was dead. It was not done because the economy was clearly weak enough to justify relief. The Fed itself still said inflation was somewhat elevated. Its own March projections showed 2025 PCE inflation at 2.7% and core PCE inflation at 2.8%. Core inflation just means inflation after taking out food and energy to see the trend underneath. So this was not a victory lap, it was a balancing act under stress. When I traced the mechanism, the picture got even more interesting. The debt ceiling was part of the pressure. The Treasury was using cash in its account at the Fed to keep paying bills while borrowing was limited. That changes liquidity in the system in odd ways. It makes reserves harder to read. Reserves are the cash buffers sitting inside the banking system. If the Fed keeps draining liquidity while those signals are distorted, it risks going too far and finding out too late. That is how plumbing problems begin. Most people never watch the plumbing. They watch speeches, dots, and rate guesses. I watch the pipes. When central banks start acting like they are worried about market plumbing, I pay attention. Because plumbing problems do not stay in the basement, they move upstairs fast. In 2019, the repo market suddenly seized up and overnight borrowing costs spiked toward 10%. That forced the Fed to step in with emergency liquidity. The lesson was simple. Liquidity can look abundant right up until it doesn't. Gold understood that lesson faster than most people did. That is why it moved. Right after the Fed signaled this softer path, gold pushed to a fresh record around $3,055 an ounce in March 2025. By that point, it had already logged 16 record highs in that year. I do not see that as blind excitement. I see it as a message from the market. Gold was saying, I heard the words, but I trusted the behavior. And the behavior said the system is more fragile than officials want to admit. This is where the obvious explanation falls short. Yes, lower rates are usually good for gold. Gold pays no yield. That means it does not send you interest like a bond. So when cash and bonds pay more, gold often looks less attractive. That is the textbook answer. But a lot of textbook answers break down when trust becomes the real issue. Gold does not only respond to the price of money, it also responds to confidence in the managers of money. And those are not the same thing. The Fed's own projections told an uncomfortable story. Real GDP growth for 2025 was marked at 1.7%. Unemployment was seen rising to 4.4%. The median Fed funds rate for year-end sat at 3.9%, which implied cuts later on. So think about what that mix means. Slower growth, higher joblessness, inflation still above target. That is not a clean, soft landing. That is an economy losing speed while prices refuse to fully behave. I have seen that combination before, and it makes central bankers very uneasy. If I sound calm when I say that, it is because I have learned that markets do their loudest damage during periods that still sound manageable on paper. A little slower growth, a little sticky inflation, a little policy confusion. None of those words sound dramatic by themselves. Together they can change the whole map. That is why I never judge these moments by one headline. I judge them by the pressure they place on the Fed's room to act, and that room is not as wide as it used to be. I often reduce big systems to one simple picture in my own mind. If my income starts wobbling, my expenses stay high, and my debt is huge, I can talk tough all I want. I can tell my family I am being disciplined. But if I quietly ask the bank for more flexibility at the same time, my words and my actions are no longer saying the same thing. That is how this felt to me. The Fed said it was still serious. The balance sheet move said it was already adjusting to limits. If that kind of hidden shift is the signal you want me to keep catching before it turns into a headline, would you subscribe and stay close? I do not chase noise here. I track the moments when policy language and policy behavior start drifting apart, because that is usually where the big money moves begin. I can already hear the objection. Maybe this was just technical. Maybe it was only about money market smoothness. Maybe it had nothing to do with a bigger shift. I think that objection is fair up to a point. Central banks do have to manage market function. They cannot let reserves get too low and cause chaos for no reason. But that is exactly why this matters. When a central bank has to change course for technical reasons before inflation is fully beaten, the system is telling me something important about its tolerance for pain. That is the part I think many people miss. The Fed does not operate in a clean lab. It operates inside a giant debt-heavy economy, inside a giant debt-heavy government, inside a global system that still leans on the dollar but trusts it a little less each year. So every time the Fed tightens, it is not only fighting inflation, it is also testing how much stress the broader structure can absorb. When it slows QT while inflation is still above target, I read that as a sign that the structure is talking back. I cannot look at this without thinking about the late 1970s. Gold exploded back then because inflation was not just high. Confidence in policy was low. Then Paul Volcker came in and took rates to brutal levels. Depending on which measure you use, the Fed funds rate pushed near 20%, and borrowing costs became crushing. That broke inflation, but it also broke a lot of things on the way. It was a very hard medicine. Gold eventually rolled over because policy regained credibility through force. Now look at today through that same lens, and the contrast is almost painful. Could the system handle a true Volcker-style response now? I doubt it. The debt load is too large. U.S. net interest outlays were projected around $970 billion for 2025 and above $1 trillion for 2026. That is just interest. That is money spent servicing old promises. When a country is paying that much to carry its debt, very high rates become more than a policy choice. They become a fiscal threat. That changes what the market believes the Fed can really do. And once the market starts doubting how far the Fed can go, gold stops behaving like a simple inflation trade. It starts behaving like a referendum on monetary credibility. That sounds abstract, but it is not. It is very concrete. If investors think the central bank cannot keep money tight for long enough, then every short burst of discipline starts to look temporary. Gold does very well in that kind of environment because it does not need a promise. It just needs doubt. I also think people underestimate how meaningful the balance sheet still is. The Fed's holdings peaked around $9 trillion in 2022. Even after a long runoff, they were still around 6.8 trillion. So yes, QT had removed a lot, more than $2 trillion had come off, but the balance sheet was still enormous by pre-pandemic standards. That matters because the financial system has grown used to living with a lot of central bank support in the background. Once a system adapts to that, taking it away becomes harder than adding it. That is why I did not dismiss the slowdown as a tiny technical tweak. I saw it as a message about the edge of tolerance. I think of a pilot lowering altitude before passengers even feel the turbulence. The move itself may look calm. The reason for it is what matters. If the Fed thought the system could comfortably absorb more drain, it would have stayed the course. Instead, it chose caution. And gold, which has spent centuries reading caution better than economists do, reacted immediately. The bigger story becomes even clearer when I zoom out beyond the Fed. Central banks around the world have been buying gold in serious size. In 2025, official sector purchases were still roughly 863 tons. That was down from the blowout pace before, but still historically elevated. Global gold demand rose to about 5,002 tons, a record. Gold ETF inflows came in around 801 tons. Bars and coins hit a 12-year high around 374 tons. Those are not random numbers to me. They show broad demand from both institutions and ordinary savers. And I do not think that demand is only about fear of war or one bad news cycle. I think it is about reserve diversification. That just means countries and investors want less of their wealth tied to one paper promise, one government, one currency block, or one sanction system. I have watched this change slowly for years. Countries like China and Poland have been among the more active buyers over time. They are not buying because gold has a clever marketing team. They are buying because trust is no longer free. That matters because the gold market is not only a Western investor story anymore. For a long time, many people in the US thought gold moved only when Wall Street funds got excited. That is outdated. Now I see a much wider base. I see central banks, private investors, bar buyers, ETF buyers, and savers across regions, all using gold for slightly different reasons that lead to the same outcome. Some want safety, some want a hedge against inflation, some want distance from the dollar, some simply want an asset outside the banking promise chain. So when the Fed eases off QT while still talking tough, it does not land in a vacuum. It lands in a world already primed to read that move as part of a larger shift. It lands in a world where geopolitical tension is high, trade friction is back, and the old idea of a stable, low inflation, low conflict global order feels less solid than it did 10 years ago. Gold is not reacting to one sentence. It is reacting to the whole environment into which that sentence was dropped. If your savings plan still assumes central banks can tighten forever, control everything, and fix every crack without cost, is that a belief you have tested lately? I ask myself that question often because money gets hurt most when people confuse official confidence with actual capacity. I should also say this clearly. Gold does not move in a straight line, and I never pretend otherwise. Even in strong bull runs, it can drop fast and scare people out. Corrections happen. Traders take profits. Real yields rise for a while. The dollar catches a bid. Headlines shift. I have seen gold look brilliant one month and foolish the next. That does not bother me as much as it bothers short-term traders because I do not ask gold to entertain me. I ask it to tell me when confidence in the system is changing. That is why I separate appearance from structure. The appearance might say the Fed is still restrictive. The structure says the Fed already has to choose where not to push too hard. The appearance might say inflation is coming down slowly. The structure says inflation is sticky enough to limit cuts, but growth is soft enough to make tight policy dangerous. The appearance might say the dollar still rules. The structure says more countries and institutions are quietly building alternatives. Gold sits right in the middle of that contradiction. A lot of people wait for the Fed to make some grand confession. They want Powell to stand up and say, the system cannot handle honest rates, the debt is too large, and the path forward will require more financial repression. Financial repression is just a polite phrase for keeping savers trapped in a system where inflation and policy slowly eat purchasing power. The Fed will never phrase it that way. It does not have to. I look for the smaller actions that reveal the same limits. This QT slowdown was one of those actions, and I think the broader pressure was building from several directions at once. Tariffs were creating new inflation worries. Geopolitical tension was driving safe haven demand. Growth fears were starting to creep in. The labor market was still okay, but not as strong beneath the surface as the top line numbers suggested. In that kind of setting, every policy move gets read not only for what it does today, but for what it implies about tomorrow. Gold rose because tomorrow started to look more constrained for the Fed than yesterday did. If I widen the lens even further, I see something else. The post-2008 world trained markets to expect rescue. The post-2020 world trained them to expect rescue fast. Even when officials try to reverse that conditioning, the memory remains. So every time the Fed shows even a small bend toward caution, markets ask the same question. If this is how the Fed behaves before a true recession, how will it behave during one? Gold is a direct way of expressing that suspicion without having to guess the exact timing. That brings me to what could happen next, because this is where I think calm matters most. One path is that inflation keeps cooling, growth slows but does not crack, and the Fed cuts gently. In that case, gold may still do fine, but the move could become more measured. I could see pauses, I could see sideways months, I could see people get bored with it. That would be the cleaner path, and frankly, the one policymakers would probably prefer. A second path is the one I take more seriously. Growth weakens, but inflation stays sticky enough to keep the Fed uncomfortable. That is a stagflation flavor. Stagflation means weak growth mixed with stubborn inflation. It is one of the hardest setups for policymakers because every fix hurts something else. In that world, real rates can stay awkward, consumer confidence can slip, and policy can look inconsistent. Gold tends to do very well when central banks are boxed in like that, because uncertainty lasts longer than most people expect. A third path is sharper and more dramatic. Something in the credit system or funding markets breaks. It could be reserves, treasury market function, commercial stress, or something nobody is watching right now. Then the Fed would likely move from cautious flexibility to open support much faster than the public expects. If that happens, gold may not wait for the press conference. It may reprice first and let the explanations come later. I have seen markets do that more than once. They move on necessity before officials move on language. If you want me in your feed when those paths start separating in real time, stay connected here. I would rather help you think clearly through a slow turn than try to shout over the panic after the turn is already obvious. As for what I watch now, I keep it simple. I watch whether inflation keeps stalling above target. I watch whether treasury auctions stay smooth. I watch signs of reserve stress and money market strain. I watch how fast central banks keep adding gold. I watch whether the dollar's strength starts to look more like habit than conviction. And I watch the Fed's balance sheet choices, because those choices often reveal more than the speeches do. When policymakers are confident, they press. When they are careful, they trim. That difference matters. I am not saying everyone should run out and bet everything on gold. I never think in absolutes like that. Gold is not a magic answer, and it is not a business that compounds cash flow on its own. What I am saying is simpler. I think this Fed move reminded me that the system is more fragile than the official tone suggests. In that kind of world, I want part of my wealth in something that does not depend on perfect policy, perfect trust, or perfect timing. That is how I think about gold at moments like this. The deepest lesson here is not really about metal. It is about limits. The Fed can set rates, it can shape expectations, it can smooth markets, but it cannot repeal arithmetic. It cannot make massive debt painless. It cannot force confidence by saying confident things. And when it starts adjusting balance sheet policy before inflation is fully beaten, I listen carefully, because that is usually the sound of arithmetic pushing back. So yes, the Fed did something unthinkable to gold, not because it attacked gold, not because it tried to help gold, but because it revealed in one quiet move that control is never as complete as it looks from the podium. Gold heard that. I heard that. I heard. And once I hear a central bank choose caution before victory, I stop listening to the headline and start listening to the system. In the end, I do not think the gold market is celebrating. I think it is warning. It is warning that policy is tighter in words than in spirit. It is warning that debt changes what central banks can truly endure. It is warning that liquidity matters more than slogans. And it is warning that when trust gets even slightly thinner, hard assets start speaking louder than promises. That is why I would not remember this moment as a technical tweak. I would remember it as a confession hidden inside a policy adjustment. The Fed blinked without saying it blinked. Gold noticed. And in markets, the asset that notices first is usually the one worth respecting most. The loud story is about rates. The quiet story is about limits. I have learned that the quiet story is usually the one that costs the most to ignore.